Scott Freeze. He's a portfolio manager at the Advisor Shares New Tech Media ETF under their suite of offerings. So let's talk a little bit about tech. Welcome back, Mr. Freeze. Let's take a look at NASDAQ because the gains continue to plow higher. What do you make of this?
Yeah, it's been a really decent time for NASDAQ, especially coming off some of the worries that we had earlier. Yeah, I'm not necessarily going to say that tech is ready to skyrocket again, or that the articles that were out over the weekend that FANG is about to rip again is necessarily true, but it has been going very well. We still see some upside in most of the technology, but a lot of rotation from the quintessential FANG names, quote unquote, to I guess pseudo FANG names in some specific sectors like 5G, cloud, security, blockchain, Internet of Things, and maybe not even include blockchain. Because there are no pure plays in it, but the companies that are actually using that to generate revenue or cut costs.
It's interesting, Scott, because when we talk about the breakdown of the index, the NASDAQ, and just tech in general, right, you see a bit of some divergence that's happened between social media and semiconductors. But on a day like today, you come off a week last week where semiconductors were rocking again. And even though they've taken a breather this Monday, you see names like Tesla to the forefront, NetEase back on top. And there really is a push for growth that is consistent across industries. It's not just limited to one or the other. It's really about finding companies that are going to continue to grow the bottom line.
Right. It's really, the market, as some people are saying, is played out, or we're in the late innings and the late stages. I think it's more late stages for some of the market leaders that we've seen over the past few years. But this is early innings for a lot of the new innovators and the smaller companies into the next hot sectors, which we talked about previously with cloud and with security and 5G. And 5G, not necessarily Sprint or Verizon or the phone carriers, but the companies that are going to build the infrastructure and are building the infrastructure for it.
Yeah.
And to, if you look at gaming, as you were talking about earlier, you could own the individual gaming stocks, or you can own the companies that are producing the chips that go into the games.
Now, Scott, how important is this classification change that's coming up later this year by those global indexers and, or rather the actual classification companies themselves, S&P, MSCI, pushing some of the telecoms into media and then basically revamping tech a little bit? This is going to be a pretty big deal. How are you guys handling it there? Will weightings actually change in your portfolios?
Well, because we're actively managed, we're not beholden to any specific index. So when you have the social media companies going into communications, it doesn't really have an impact on us. We're not benched to any specific index. But if you look at, if you look at the FANG names, Netflix, which is going to switch, still a fantastic performer, still has tons of upside. Facebook. Really, it's more of a value stock than a growth stock, and leaving the tech index and going to a communications index, I think that's going to impact that stock because you're not going to have anybody just pouring their money into an index and getting the boost from it. You'll probably see a short-term bump in the communication ETFs, the communication stocks because of that, but I don't see any long-term push into communications. I think it'll be more stock by stock specific, where people start picking out the best of breed as opposed to just buying a large cap tech index.
So Scott,
or in this case, large cap communications.
Yeah. So Scott, today we also were talking with folks at the New York Stock Exchange as they launched options on the FANG Plus futures. So a critic could look at this market, they see options on futures, they see a myriad of different types of either ETFs or funds of various sorts tracking things within this tech growth space, and they say, all right, this is the hallmark late cycle bubble. What do you say to that? Does the enthusiasm outweigh some of the fundamental disruptive technology and fundamental earnings growth that can happen here?
Oh, absolutely. Especially if you look at on a stock by stock basis for something like the FANG futures, which is just those 10 stocks. I mean, just looking at Google itself, it's underperformed the indexes for the last 52 weeks. It's still a media darling, but it's just not performing. You look at Facebook, it's barely performing above the indices. They have Tesla in there, which we've spoke about numerous times before. Elon Musk comes out and says every quarter, every week, we're going to produce X number of cars, and then comes back and says, sorry, we didn't make it, and there's no ramifications to it.
Right.
There's a lot of securities and a lot of companies that are in the late stages that have gone from growth to value or just ridiculously overpriced until you actually put up and prove that you can produce. And they're stuck in those indexes, but it's still the retail investor mind frame that these are the growth stocks and these are the things that are going to go up and they're going to double every year. And we've seen just in the past 52 weeks alone that that's just not the case.
Scott, when I look at, correct me if I'm wrong here, but just looking at the Advisor Shares breakdown for the New Tech Media ETF, it seems like as of the last reporting for April 30th, there was about 8% cash. Is that a high, low level? Has that changed as the market has come back? Curious to know how you guys build that into the weightings.
Yeah, that's a significantly high number. I think the most we've been is 10% or 12% during the meltdown January, February timeframe. Right now, I think we're at 0.02%. I think we might have $25,000 cash total.
Okay.
So we are all in invested. We do not have Facebook in the portfolio. We do not have Alphabet in the portfolio. And we recently sold Twitter out of the portfolio and have made our move into smaller cap names that have, just since we made the change at the beginning of the month, have been significantly outperforming.
Scott, let me ask you about Twitter real quick before I let you go, just because we saw that getting a little bit of a bump into its own classification in the S&P 500. Why the withdrawal of Twitter from the fund?
Just strictly on a valuation standpoint, I think we owned it at $25 a share, and it had exceeded our price points and expectations. So kind of the same argument that you make with Facebook or Google. If you get the performance that you're looking for and you don't think that the growth is there vis-a-vis other opportunities that you can put in for your investors, then we'll just book the profits and move on to something else. If something does structurally change with Twitter, or something new happens, then we could always add it back in. And I do expect to see a World Cup bump, obviously, but I just don't think that the returns on Twitter would be as great as some of the names that took its place in the portfolio.
All right, appreciate it, Scott Freeze. Great to have you here and good, candid insight into the tech group. Appreciate you joining, Scott. Scott Freeze is the portfolio manager at the Advisor Shares New Tech Media ETF and CIO at Sabertooth Advisors.